Top energy companies outperforming the S&P 500 so far this year, coming as oil CEOs attended a meeting at the White House on Wednesday afternoon. Here with more, we got Ed Hers, University of Houston's energy fellow. Ed, it's great to speak with you here. When you look at that chart and you see energy outperforming the S&P 500 in a moment with so much uncertainty about where this market is heading, investors who are in on those energy names want this dynamic to continue. What does the Trump administration have to do to not stand in the way of the momentum of these energy names?
It's going to be very difficult. Keep in mind the energy portion of the S&P 500 has underperformed everything in the S&P 500 for the last dozen years. The fact of the matter is the U.S. is the high-cost producer for oil in the global market. OPEC Plus has increased production, acknowledging the cheating that's been going on. And the target is a much lower oil price. Trump, during the campaign, said that he wanted $1.87 a gallon gasoline. Well, that would mean the price of oil would have to be below $50 a barrel. And that will really hammer oil development across the United States. In the Dallas Federal Reserve survey of the last quarter of 2024, more than 80% of the producers said they were not going to consider investing unless they could see a sustained price of greater than $70 a barrel.
So with that in mind, it sounds like drill baby drill would be more adverse actually to some of the companies that have their fiduciary duty to investors as well to maintain a certain profit margin and operating margin that they've been able to deliver for years at this juncture.
Yeah, drill baby drill is not going to happen. The oil execs have explained that to the president. Scott Sheffield last week, the former CEO of Pioneer, who's told his company Exxon, said that they had run through their tier one acreage, and the acreage is becoming gassier. The fact that the market is in favor of the energy stocks right at this moment really is pointing towards gas and a prospect of using more natural gas for LNG exports and for electricity generation. But as we know, the backlog for gas turbines is well out into the 30s at this point. We're not going to be able to pivot that quickly. The LNG facilities that are underway are going to come on incrementally. We have a huge amount of natural gas that's stranded because of a lack of pipelines. Keep in mind that in Trump 1.0, both the Constitution and the Atlantic pipeline were canceled. If those had been in place, we would certainly see a rosier future for some of the gas producers.
We've talked a lot about the impact of tariffs on oil and gas. What about the impact of immigration policy?
I think that's something very few people outside of the oil patch have focused upon. Joe Sixpack is not going to go work on a rig floor in 150-degree heat in West Texas. And if mass deportations come to West Texas, we're going to see maybe a drop of 10 to 20% in the workforce. We also know that the contractors that work across the refineries and the petrochemical complex hire a lot of undocumented workers. It's plausible deniability for the owners of these refineries. Houston has about 600,000 undocumented workers. So there's going to be a squeeze on the cost side for all of these oil and natural gas producers, from the steel, from the aluminum, and then from the workforce.
You also have an input where there's going to be more production, I believe, coming out of Libya, one of the areas. And then even as OPEC considers the non-members, I should say, that are going to be increasing their production at a time where they're trying to best coordinate with their OPEC Plus members about where production should stay in order for oil markets not to be amazingly volatile. How do you evaluate some of those new inputs for production internationally?
Well, the new inputs have been coming along. Guyana, which is an Exxon Hess development, has been doing really pretty well. It's 1 million barrels a day, potential up to 2.5 million barrels a day. Libya is coming back online. Russia has been exporting more oil than it was producing prior to the invasion of Ukraine. This oil gets to market. We're 103 million barrels a day, roughly. We've never had a larger oil market. And every producer across the globe is a lower cost producer than the United States. they can run us off the table anytime. We remember the price war that kicked off in 2014 against the shale plays. We also recall that in Trump 1.0, the president told MBS that the price for getting away with murder was low oil prices, and Saudi Arabia followed up with lower oil prices. The new high 13 million plus barrels a day came during the Biden administration. It doesn't look like the Trump administration is going to really be able to do anything to expand production and maintain a low price.
Ed, thanks so much for the context and the insights here. Appreciate the analysis.